Hello and welcome to the WealthWave channel, your go-to source for all things related to finance and investment. Here at WealthWave, we aim to provide you with the most current and insightful information to help you navigate the often turbulent waters of financial markets. Whether you're a seasoned investor or just dipping your toes into the world of finance, we've got something for everyone. So if you find our content useful, don't forget to hit that subscribe button and give us a like. Without further ado, let's dive into today's topic. Before you jump into the stock market, it's essential to define your investment objectives. This is the compass that will guide you through the vast ocean of investment opportunities. So, what does setting investment objectives mean? Well, it's all about understanding why you're investing in the first place. Are you looking to build a nest egg for your retirement years? Or are you hoping to make a quick profit? These are just two examples of the countless reasons why people invest. The important thing is to identify your own why. Setting clear, realistic investment objectives is not just a good to have, it's a must-have. Without a clear sense of purpose, you're like a ship adrift in the sea, susceptible to being tossed around by the waves of market volatility. And this can lead to hasty decisions, which more often than not result in potential losses. But let's not get overwhelmed. Setting investment objectives is not rocket science. It's about asking yourself some key questions like, what are my financial goals? What is my risk tolerance? And what is my investment timeline? Let's break these down a little bit. When we talk about financial goals, we're talking about what you want to achieve with your investment. This could be anything from buying a home, funding your child's education, to planning for retirement. Your risk tolerance is about how much risk you're willing to take on. Remember, all investments come with some level of risk. Understanding your risk tolerance helps you choose investments that align with your comfort level. Lastly, your investment timeline refers to the amount of time you're willing to keep your money invested before you need it back. This could range from a few years to a few decades. So, there you have it. Setting clear, realistic investment objectives is like setting the GPS before you start your journey. It helps you stay on track, make informed decisions, and ultimately reach your destination. Remember, clarity in your investment goals is the first step towards successful stock investing. Now that you've defined your investment objectives, it's time to do some homework. And by homework, we mean thorough market research. You see, stepping into the world of investment without a solid understanding of the market is like diving into the ocean without knowing how to swim. You wouldn't do that, would you? So how do you go about this? First off, identify high-performing companies. This isn't about choosing the most popular names or the ones making headlines. It's about digging deeper, looking at the numbers, and finding those that consistently perform well. Consider factors like profit history. A company that has a proven track record of generating profits is more likely to continue doing so. Financial stability is another crucial factor. A company with a strong financial foundation is less likely to crumble under the pressure of economic downturns. Next, look at the company's growth. A company that's growing indicates that it's doing something right. It's meeting market demand, it's innovating, it's expanding. All these are positive signs for an investor. But remember, every company operates in a market, and no market is without competition. So consider the competitive landscape as well. How does the company stack up against its competitors? Is it a market leader, a challenger, or a small player? And while we're talking about competition, consider the overall health of the market too. Is it growing, stable, or declining? A growing market offers more opportunities for a company to expand and increase its profits, while a stable market promises consistency. A declining market, on the other hand, could spell trouble. Let's not forget that the market is not a static entity. It's dynamic, ever-changing. So keep your research updated. What worked yesterday might not work today. And finally, remember that research is not just about gathering information. It's about analyzing it, understanding it, and using it to make informed investment decisions. So don't rush it. Take your time. Be thorough. Be meticulous. Investing time in research now will pay off in your investment decisions later. After all, knowledge isn't just power. In the world of investment, it's profit. It's not just about picking the right stocks. It's also about spreading your risk. That's where the concept of diversification comes in. Just as you wouldn't want all your eggs in one basket, you wouldn't want all your money invested in one stock or sector. Diversification is about spreading your investments across different areas to minimize your risk. Think of it this way: if you're only invested in one company and that company takes a hit, your entire portfolio suffers. But if your investments are spread out across different companies in various sectors, the effect of one company's downturn is minimized. This is the beauty of diversification. But diversification isn't just about investing in different companies. It's also about investing in different sectors. You may be familiar with the saying, "Don't put all your eggs in one basket." Well, in investing, that basket can be a sector. If you're only invested in technology stocks, for example, and the tech sector experiences a slump, your entire portfolio could take a hit. Geographical diversification is another important aspect. Investing in different countries or regions can also help reduce risk. If the economy in one country or region takes a hit, the impact on your portfolio may be cushioned by your investments in other regions where the economy is doing well. Finally, diversification also applies to types of financial instruments. You can diversify your portfolio not just with stocks, but also with bonds, real estate, commodities, mutual funds, and other financial instruments. Each of these has its own risks and returns, and combining them in a balanced way can help smooth out the ups and downs in your portfolio. Remember, the goal of diversification isn't necessarily to boost performance, it's to reduce risk. Even the most experienced investors can't predict the future. Diversification provides a kind of insurance against the uncertainty of the markets. A well-diversified portfolio is your safety net in the volatile world of stock investing. Don't let one bad apple spoil the bunch. Spread out your investments, and you'll be better equipped to weather the storms of the stock market. Investing in stocks always comes with risks, but there are ways to manage and minimize these risks. One of the crucial strategies to manage investment risk is setting loss limits. It's like having a safety net. You identify an acceptable level of loss, and if the value of your stocks dips below that level, you get out. This strategy helps you prevent a free fall and cap your losses. Another strategy is to invest in stable companies. Companies with a track record of profits and financial stability are less likely to suffer significant losses. It's like choosing a sturdy ship to sail in choppy waters. You want to be sure your ship won't sink at the first sign of a storm. And we circle back to a point we discussed earlier, diversifying your portfolio. By spreading your investments across various companies, sectors, geographies, and financial instruments, you're effectively putting your eggs in different baskets. If one basket falls, the eggs in the other baskets remain safe. Risk management, in essence, is about making smart, calculated decisions. It's about not letting fear or greed cloud your judgment. It's about understanding that the stock market will have its ups and downs, and not panicking when things go south. Remember, the stock market is not a casino. It's not about betting all your money on one number and hoping for the best. It's about making informed decisions based on research and analysis and sticking to your plan. And most importantly, it's about patience. Good things come to those who wait, as the saying goes. You won't become a millionaire overnight, but with patience and discipline, you can grow your wealth gradually and steadily. So as you embark on your investment journey, keep these risk management strategies in mind. They'll help you navigate the choppy waters of the stock market and reach your financial destination safely. Mastering risk management is key to maintaining your cool in the face of stock market fluctuations. Patience pays off in stock investing. It's a marathon, not a sprint. This adage holds true when it comes to the world of investing. To reap the real benefits of stock investing, it's crucial to have a long-term strategy in place. A long-term investment strategy is like a compass guiding you through the volatile waves of the stock market. It helps you maintain your focus, make rational decisions, and resist the temptation to follow the crowd. Many new investors often fall into the trap of jumping from one stock to another, chasing market trends or the latest news. This lack of discipline can lead to irrational decisions driven by emotions, which can negatively impact your returns. Remember, investing isn't about making a quick buck. It's about growing your wealth steadily over time. So don't let short-term market fluctuations derail you from your long-term investment goals. A long-term investment strategy keeps you focused, rational, and resistant to following the crowd. And that wraps up our guide to successful stock investing. We've covered setting clear investment objectives, the importance of thorough market research, the power of diversification, strategies for managing risk, and the value of a long-term investment strategy. Each of these elements is critical to creating a successful investment plan. If you've made it this far, thank you for watching. Don't forget to subscribe, like, and turn on notifications to stay updated with more content from WealthWave.